Hello there. This is Park Young-min, your lecturer for the Global IB course. Last time, we talked about syndicated loans as an important concept in Global IB. Today, in our fourth session, we're going to take a closer look at syndicated loans. Syndicated loans are group loans that is loaned on common terms by many lenders. One or more financial institutions underwrite using a universal with common terms and conditions across all lenders. Since it is a group loan between several financial companies, a syndicated loan needs to bring different financial players together. The entity responsible for doing that is called a mandated lead arranger, MLA. In other words, an MLA is an entity that arranges and leads various financial corporations. Say, for example, you've ordered some pizza. An MLA is the person who orders the pizza and brings people together to eat the pizza. And the friends invited to eat the pizza are participating lenders. Now, for convenience, we'll refer to the sponsor who proposes an investment as a borrower. Typically, a borrower with an investment project would request several global financial corporations to finance the funds through loan requires for the project. Upon receiving the request, each financial corporation would present its main financial terms in the form of a term sheet. The borrower selects the financial corporation offering the best terms and conditions, and then issues a mandate. When issued, a mandate grants an exclusive right to the MLA in order to finance the required funds. First, a mandate specifies no shopping, which means the borrower will not request financing from another corporation. Second, the mandate specifies market clearance, which refers to a commitment not to disrupt financing efforts. The financial corporation, which formally receives a mandate from the borrower, is called the mandate lead arranger, or MLA for short. Now, the MLA will provide a commitment to finance through an internal decision-making process. Here, this commitment is documented in the form of a letter of comfort, LOC. The MLA will provide the borrower with the total amount it requires, which is called full underwriting. In other words, the borrower trusts the MLA to secure the funds it requires in full, and the MLA makes a full underwriting commitment with an LOC. An MLA has four main functions. The first is called sourcing. Sourcing is about finding suitable borrowers and presenting them with the best borrowing terms and conditions. The second is called structuring. Structuring refers to creating the financial and contract structures that meet the needs of the borrower and the needs of the lender at the same time. The third is called selling. Now, selling means to recruit potential lenders looking to take a loan together in the financial market. The fourth is called servicing. Servicing refers to the management of a loan from the point of withdrawal to maturity. This particular function is served by what is called an agent bank. More often than not, the MLA also functions as the agent bank. In the deal sourcing process, MED is important. This means that the deal is profitable, easy to handle, and easy to invite syndicate lenders. An MLA has to bring several syndicates or lenders together. That is why a deal has to be easy to handle. In other words, an MLA has to order a pizza that everyone can eat. Naturally, it has to consider what its friends like and dislike before it places the order. If a fund is too large, it may be difficult to recruit enough investors in the market. To reduce such risk, an MLA may designate and utilize sub-lend arranger, LA, to have them finance parts of the overall funding requirement. Think about a classroom. Each class has a class president. But if a class is too large, the class president may have vice presidents or a student council to help manage the class. An MLA using an LA is similar to that. Once the funds are financed and it comes time to actually sign the contracts, the agent bank becomes an intermediary that facilitates the signing processes between the syndicates and the borrower. As the agent of participating lenders, the agent bank is responsible for the payment and withdrawal of funds, the communication between the borrower and the participating lenders, and the communication between the participating lenders themselves. Arranging finance is a task that requires expertise and experience to meet the needs of the borrower. And arrangement also requires a network capable of recruiting lenders, given the degree of difficulty. The MLA receives a fee for arranging the funds. And this financial service fee can potentially become an engine that generates non-interest revenues for financial institutions, engaging in investment banking. When an MLA receives a fee from the borrower, it distributes part of it to other syndicates or participating lenders. If the MLA had used an LA during the funding process, it will divide its fees to the LA as well. Meanwhile, the agent bank receives a dedicated agent bank fee on an annual basis. In the syndicated loan agreement will be made to reflect each of the needs of the owners. The process of negotiating a loan agreement between the borrower and lenders for a syndicated loan is called documentation. The borrower and the lenders each appoint an external law firm and discuss the contents of the contract drafted based on the term sheet to make sure their interests are protected. This documentation process typically takes a while, as the borrower has to be comfortable with the contract, and the lenders have to be sure their loan will be safe. The MLA recruits lenders by utilizing its interorganizational networks in various international financial markets. It will send an invitation letter with all of the expected financial terms to a large number of potential lenders. When a potential lender expresses its interest to participate, the MLA sends an information memorandum, IM, designed to help the decision-making process. Upon reviewing the IM, the potential lender goes through its internal approval process and decides whether or not to participate in the syndicated loan. Simply put, an invitation letter is like a text message that invites your friend to come and eat some pizza. The IM is a detailed flyer that tells your friend whether the pizza is delicious, healthy, and free of any allergy-inducing ingredients. The friend who receives the invitation will see if the pizza looks appetizing and decide to eat it or not. The place where your friends are can be thought of as a global syndicated loan market. International financial centers, such as New York, London, and Hong Kong, correspond to these global syndicated loan market. In summary, a syndicated loan follows this procedure. It goes through the origination phase, which a financial corporation finds a borrower looking for a deal, then the syndication phase, where the financial corporation recruits potential lenders and draws up terms capable of satisfying the needs of both the borrower and lenders.